Liability insurance. Liability insurance is a very broad superset that covers legal claims against the insured. Many types of insurance include an aspect of liability coverage. For example, a homeowner's insurance policy will normally include liability coverage, which protects the insured in the event of a claim brought by someone who slips and falls on the property. Automobile insurance also includes an aspect of liability insurance that indemnifies against the harm that a crashing car can cause to others' lives, health, or property. The protection offered by a liability insurance policy is twofold: a legal defense in the event of a lawsuit commenced against the policyholder, and indemnification with respect to a settlement or court verdict. Liability policies typically cover only the negligence of the insured and will not apply to the results of willful or intentional acts by the insured. It includes 1. Public liability. Insurance or general liability insurance covers a business organization against claims should its operations injure a member of the public or damage their property in some way. 2. Directors and officers liability insurance, that is D&O. It protects an organization from costs associated with litigation resulting from errors made by directors and officers. 3. Environmental liability or environmental impairment insurance. It protects the insured from bodily injury, property damage, and cleanup costs as a result of the disposal, release, or escape of pollutants. 4. Errors and omissions insurance (E&O) is business liability insurance for professionals such as insurance agents, real estate agents and brokers, architects, third-party administrators, and other business professionals. Price indemnity insurance protects the insured from giving away a large prize at a specific event. Examples would include offering prizes to contestants who can make a half-court shot at a basketball game or hole-in-one at a golf tournament. Professional liability insurance, also called professional indemnity insurance (PI), protects insured professionals such as architectural corporations and medical practitioners against potential negligence claims made by their patients or clients. Professional liability insurance may take on different names depending on the profession. For example, professional liability insurance in reference to medical profession may be called medical malpractice insurance. Often a commercial insured liability insurance program consists of several layers. The first layer of insurance generally consists of primary insurance, which provides first dollar indemnity for judgments and settlements up to the limits of liability of the primary policy. Generally, primary insurance is subject to deductible and obligates the insured to defend the insured against lawsuits, which is normally accomplished by assigning counsel to defend the insured. In many instances, a commercial insured may elect to self-insure above the primary insurance or self-insured retention. The insured may have one or more layers of excess insurance to provide coverage, additional limits of indemnity protection. There are a variety of types of excess insurance, including standalone excess policies, follow-form excess policies, umbrella insurance policies, and surplus lines policies. Credit insurance. Credit insurance repays some or all of a loan when the borrower is insolvent. Mortgage insurance insures the lender against default by a borrower. Mortgage insurance is a form of credit insurance, although the name credit insurance is more often used to refer to policies that cover other kinds of debt. Many credit cards offer payment protection plans, which are a form of credit insurance. Trade credit insurance is business insurance over the accounts receivable of the insured. The policy pays the policyholder for covered accounts receivable if the debtor defaults on payment. Collateral protection insurance insures property, primarily vehicles, held as collateral for loans made by lending institutions. Other types of insurance. An all-risk insurance is an insurance that covers a wide range of incidents and perils, except those noted in the policy. All-risk insurance is different from peril-specific insurance that cover losses from only those perils listed in the policy. In car insurance, all-risk policy includes the damage caused by own driver. Bloodstock insurance covers individual horses or a number of horses under a common ownership. Coverage is typically for mortality as a result of accident, illness, or disease, but may extend to include infertility, in-transit loss, veterinary fees, and prospective foal. Business interruption insurance covers the loss of income and expenses incurred after a covered peril interrupts normal business operations. Defense Base Act Insurance (DBA) provides coverage for civilian workers hired by government to perform contracts outside the national boundaries. Depending on the country, foreign nationals may also be covered under DBA. This coverage typically includes expenses related to medical treatment and loss of wages, as well as disability and death benefits. Expatriate insurance provides individuals and organizations operating outside of their home country with protection for automobiles, property, health, liability, and business pursuits. Legal expenses insurance covers policyholders for the potential costs of legal action against an institution or an individual. When something happens which triggers the need for legal action, it's known as the event. There are two main types of legal expense insurances: before the event insurance and after the event insurance. Livestock insurance is a specialist policy provided, for example, to commercial or hobby farms, aquariums, fish farms, or any other animal holding. Cover is available for mortality or economic slaughter as a result of accident, illness, or disease, but can extend to include destruction by government order. Media liability insurance is designed to cover professionals that engage in film and television production and print against risks such as defamation. Nuclear incident insurance covers damages resulting from an incident involving radioactive materials and is generally arranged at the national level. Pet insurance insures pets against accidents and illnesses. Some companies cover routine wellness care and burial as well. Pollution insurance usually takes the form of first-party coverage for contamination of insured property either by external or on-site sources. Coverage is also afforded for liability to third parties arising from contamination of air, water, or land due to the sudden and accidental release of hazardous materials from the insured site. The policy usually covers the costs of cleanup and may include coverage for releases from underground storage tanks. Intentional acts are specifically excluded. Purchase insurance is aimed at providing protection on the products people purchase. Purchase insurance can cover individual purchase protection, warranties, guarantees, care plans, and even mobile phone insurance. Such insurance is normally very limited in the scope of problems that are covered by the policy. Tax insurance is increasingly being used in the corporate transactions to protect taxpayers in the event that a tax position it has taken is challenged by the tax authority. Title insurance provides a guarantee that title to real property is vested in the purchaser and/or mortgage, free and clear of liens or encumbrances. It's usually issued in conjunction with the search of the public records performed at the time of a real estate transaction. Travel insurance is an insurance cover taken by those who travel abroad, which covers certain losses as medical expenses, loss of personal belongings, travel delay, and personal liabilities. Tuition insurance insures students against involuntary withdrawal from cost-intensive educational institutions. Interest rate insurance protects the holder from adverse changes in interest rates, for instance, for those with a variable rate loan or mortgage. Divorce insurance is a form of contractual liability insurance that pays the insured a cash benefit if their marriage ends in divorce. Insurance financing vehicles. Fraternal insurance is provided on a cooperative basis by fraternal benefit societies or other social organizations. No-fault insurance is a type of insurance policy, typically automobile, where insureds are indemnified by their own insurer regardless of fault in the incident. Protected self-insurance is an alternative risk financing mechanism in which an organization retains the mathematically calculated cost of risk within the organization and transfers the catastrophic risk with specific and aggregate limits to an insurer so that the maximum total cost of program is known. A properly designed and underwritten protected self-insurance program reduces and stabilizes the cost of insurance and provides valuable risk management information. Retrospectively rated insurance is a method of establishing a premium on large commercial accounts. The final premium is based on the insured's actual loss experience during the policy term, sometimes subject to a minimum and a maximum premium, with the final premium determined by a formula. Under this plan, the current year's premium is based partially or wholly on the current year's losses, although the premium adjustments may take months or years beyond the current year's expiration date. The rating formula is guaranteed in the insurance contract. Formula is retrospective premium equals converted loss plus basic premium into tax multiplier. Numerous variations of this formula have been developed and are in use. Formal self-insurance is a deliberate decision to pay for otherwise insurable losses out of one's own money. This can be done on a formal basis by establishing a separate fund into which funds are deposited on a periodic basis, or by simply foregoing the purchase of available insurance and paying out of pocket. Self-insurance is usually used to pay for high-frequency, low-severity loss. Such losses, if covered by conventional insurance, mean having to pay a premium that includes loadings for the company's general expenses, cost of putting the policy on books, acquisition expenses, premium taxes, and contingencies. While this is true for all insurance, for small, frequent losses, the transaction costs may exceed the benefit of volatility reduction that insurance otherwise affords. Reinsurance is a type of insurance purchased by insurance companies or self-insured employers to protect against unexpected losses. Financial reinsurance is a form of reinsurance that's primarily used for capital management, rather than to transfer insurance risk. Social insurance can be many things to many people in many countries. But a summary of its essence is that it's a collection of insurance coverages, including components of life insurance, disability income insurance, unemployment insurance, health insurance, etc., plus retirement savings that requires participation by all citizens. By forcing everyone in society to be a policyholder and pay premium, it ensures that everyone can become a claimant if he or she needs to be. Along the way, this inevitably becomes related to other concepts such as the justice system and the welfare state. This is a huge, complicated topic that engenders tremendous debate, which can be further be studied under the following heads: national insurance, social safety net, social security debate, social security provision. Stop loss insurance provides protection against catastrophic or unpredictable losses. It's purchased by organizations who do not want to assume 100% of the liability for losses arising from the plans. Under a stop loss policy, the insurance company becomes liable for losses that exceed certain limits called deductibles. Closed community and governmental self-insurance. Some communities prefer to create virtual insurance among themselves by other means than contractual risk transfer, which assigns explicit numerical values to risk. A number of religious groups, including the Amish and some Muslim groups, depend on support provided by their communities when disaster strikes. The risk presented by any given person is assumed collectively by the community, who all bear the cost of rebuilding lost property and supporting people whose needs are suddenly greater after loss of some kind. In supportive communities where others can be trusted to follow community leaders, this tacit form of insurance can work. In this manner, the community can even out the extreme differences in insurability that exist among its members on the basis of differences in income. Some further justification is also provided by invoking the moral hazard of explicit insurance contracts. Examples: in UK, the Crown did not insure properties such as government buildings. If a government building was damaged, the cost of repair would be met from public funds because, in the long run, this was cheaper than paying insurance premiums. Since many UK government buildings have been sold to property companies and rented back, this arrangement is now less common and may have disappeared altogether. In the US, the most prevalent form of self-insurance is governmental risk management pools. They are self-funded cooperatives operating as carriers of coverage for majority of governmental entities today, such as county governments, municipalities, and school districts. Rather than these entities independently self-insure and risk bankruptcy from a judgment or catastrophic loss, such governmental entities form a risk pool. Such pools begin their operations by capitalization through member deposits or bond issuance. Coverage such as general liability, auto liability, professional liability, and property is offered by the pool to its members, similar to coverage offered by insurance companies. However, self-insured pools offer members lower rates due to not needing insurance brokers and increased benefits such as loss prevention services and subject matter expertise. Of approximately 91,000 distinct governmental entities operating in the United States, 75,000 are members of self-insured pools in various lines of coverage, forming approximately 500 pools. Although a relatively small corner of the insurance market, the annual contributions, that is, self-insured premiums, to such pools have been estimated up to $17 billion annually.